Hello, everybody. We start the session 2 of the course Cash Management. I hope you can hear me well. So just ask you the question, can you hear me well? And tell me if there is a problem with the sound. Hello. So I show you the PowerPoint also, and tell me if there is a problem with the PowerPoint. So normally you should see the PowerPoint now. And I move the slide to the other slide. Is it okay? So here is the bibliography and after the brief contents. I can hear you well. I can see the slide. Perfect. Thank you. Thank you very much. So I added chapters from a book in the modules. I created a new module. The last one, chapters in financial accounting and reporting, is from this book. This one. It's a book from HEC, a business school in Paris, and with a professor in China, and previously in HEC also. So I put two chapters, chapter 16 and chapter 17, is because there are chapters about the statement of cash flows. So yesterday you asked for documents, chapters of books in order to understand. Please, mute the microphone, please. Yes, thank you. So I put two chapters, chapter 16 and chapter 17 from this book in here in order to revise or to read something about the statement of cash flows if you need it. So I added in the bibliography this book, and what you need from this book is the chapter 16 and 17, and they are available on Canvas. So yesterday we saw the direct and indirect methods. You have the choice between the two methods in the statement of cash flows. We did one exercise in order to create the calculation of the operating cash flow with the indirect methods. With the indirect methods, we suppose the P&L is already created. The balance sheet is already created for the year. So because you have already the balance sheet and the P&L, you can show the calculation of the operating cash flow from the P&L, the balance sheet, and the notes. In reality, you need more information. For instance, this information is not directly available in the balance sheet. So we saw yesterday the two steps. Normally in the indirect methods, we consider two steps. Step number one is just about the P&L. We are at the level of the P&L. We eliminate, we add back the non-cash expense and revenue. So the expense and revenue without an impact on the cash during the period. In the second step, we want the change in operating assets and the change in operating liabilities. The two together, operating assets minus operating liabilities. For the current part, for the short term, we name it operating working capital or working capital requirement. So now we are at the level of the balance sheet. And at the end, we finish with the operating cash flow. What we saw yesterday, I modified the exercise and I gave you on Canvas the new version. What you need to eliminate in the DNA, you add back the DNA, but what you add back is not just the DNA included in your P&L. What you add back also, it's the change in DNA because of what you put in your inventories. So what you want to eliminate, to add back, it's all the DNA of the period. Not just the DNA, here just the DNA related to the cells. In the PNL, you have only what is related to what you sell. Okay? But in reality, what you need to eliminate is all the depreciation amortization because you want the cash. So if you increase in the DNA in your inventories, it means during the period you have DNA in the factory, you produce and you don't sell it. So you increase your inventory. You increase by 50,000 the DNA included in your inventories. So it's DNA of the period. But for the DNA of the period, you don't pay. What you pay is your investments. So what you need to eliminate is all the DNA of the period, not just the DNA for sales volume. Don't forget, in your inventory, we are at full cost. So we include also the DNA inside the inventories, but you don't pay the DNA inside the inventories. So you eliminate with this one also the DNA included in inventories. So in this presentation, in this presentation, we have directly the gross value before allowance for the full accounts, gross value before the write-down of inventories, because all the change in allowance for the full account and the write-down of inventories is already here. So here we have already the change in this part, so we can start from the gross value. In the second presentation, we have only the non-cash expense and revenue. Sorry, I don't need to write here. In the second presentation, you have only the non-cash expense and revenue for the non-current assets. In reality, just non-current assets. Okay, here. So because you don't have the write-down of inventories, you don't have the bad debt expense or the reversal, what you need is the net value. So because you don't include all the non-cash expense and revenue in the first part, in the third part here, you take directly the net value. With the net value, you do two things. With the net value, you eliminate, you add back some non-cash expense included in this one. And you have also the cash impact. Okay. So the cash impact of the accounts receivable is minus 1.2 million. And what we eliminate is all this. In the second part, we have directly only one amount. So in reality, the cash impact is more than 1,060,000. The cash impact is here, is 1.2 million. It's the same for the inventories. Here we have the change with the cash impact, 270,000, because we increase the inventories at gross value by 270,000, we have to pay for that. Or we can exclude the DNA. Of course, here is with the cash impact, but one part is because of the DNA. So it's not totally with the cash impact. You have to eliminate also the DNA. So in reality, here we increase by 50 plus 50. So if you want the cash impact, it should be the 270,000 minus the 50. So this is what you spend for your inventory. But here you see you have only minus 40. In the minus 40, in fact, you have different things. In the minus 40, you have the minus 270, but also the write down of inventories, 230. The two together, plus 230 minus 270, we have minus 40,000. So with the second presentation, we could consider we spend only 40,000 for the increase in inventory, but it's false. This is not the cash impact of the increase in inventory. The cash impact is more than that. The cash impact is more in this one or in the 270,000 minus the increase in DNA inside inventory. So the real cash impact is 220. So it's more than just the minus 40 because we spend for the increase in the inventory, but at the same time, we have a reduction in value of inventory. So don't forget, when you take two balance sheets, opening, ending, the difference between the two is because of the inflows and outflows. Here we have directly all the change. But the cash impact is only a part of the change. If we spend the cash in order to increase inventories, it's a part of the change. The rest can be without a cash impact. For instance, the write down of inventories. So generally, we have this presentation. This is the usual presentation of the indirect methods. But the problem of these methods is we have the net value. In the net value, we have a change, not only because of what we spend or what we don't collect during the period, but also we have the impact of the reduction in value in accounts receivable, what we name bad debt expense, reduction in value of inventories, what we name write down of inventories. So the problem of this presentation is we don't have the real cash impact. We don't spend 40,000 for the inventories. We spend more than that. What we don't collect is not 1,060,000, is more than that. So it's false, the information we have here, if we want the cash impact. It's because we have the net value and not the gross value. So in the indirect methods, we start from the P&L with all expenses and revenues. And in reality, what we want is only the cash expenses and the cash revenues. So we need to eliminate the depreciation, amortization, depletion, impairment losses, provision is for the long term. And we have also for the short term, we have the write down of inventories. We have the allowance for the full accounts or the bad debt expense. And we can have reversals in the non-cash revenues, reversals of depreciation, amortization, depletion, and so on. So cash expense means because of this expense, we have an impact on the cash during the period. Maybe we don't pay everything now, but we have an impact on the cash. Non-cash expense, we don't have an impact on the cash during the period. So here, we don't have to pay during the period. So if we keep only the cash revenues and cash expenses, we have what we name the potential operating cash flow. With the indirect methods, we want this potential operating cash flow. Why is potential? It's because we stay at the level of the P&L. So here we have only the P&L. In the P&L, you don't have the cash inflows and the cash outflows. If you want the cash inflows and outflows, you are in the cash budget, you are in the statement of cash flows. So because we stay at the level of the P&L, it's only potential. Potentially, we should have this cash, but maybe we don't have the cash now. Maybe we'll have the cash later, or maybe we have already the cash in advance. So it's only potential. With the indirect methods, we have already the net income. From the net income, we want to come back to the potential operating cash flow. So we want to exclude the non-cash expenses, non-cash revenue. So the step number one is here in the indirect methods. In the step number one, from the net profit, we eliminate the non-cash expense. So it was in minus in the calculation of the net income. So now it's plus, and minus non-cash revenues. So don't forget what is important here is the starting point. Here, I create a new slide. Home, new slide. I create columns. I will put 4 columns and different lines. So what is the starting point in your indirect methods? In function of the starting point, you don't eliminate the same non-cash expense and non-cash revenue in order to finish with the potential operating cash flow. If you start from the net profit, you need to eliminate, so you do plus a D&A expense, plus impairment losses, plus depletion, what we said, plus the provisions, plus provision, and the non-cash revenue, plus reversal of D&A expense, plus reversal of impairment losses, and so on, plus reversal of depletion, plus reversal of provision. Okay. But if you start from the EBITDA, in this case, you don't have the D&A expense. So you don't need the D&A expense. The question is, in the EBITDA, do you include or not the impairment losses? Do you include some depletion provision? So we can suppose we have already the provision, for instance. So we have plus provision only. It's the same here. We have plus reversal of provision. It depends what you include in your EBITDA. And it's the same for the second part. So it is in the step 1. In the step 2, insert. In the step 2, you have the change in current operating assets and liabilities. Here, no, sorry, here, I reduce. Okay. Because you have already the income tax, you need the change in deferred and tax liabilities or assets. current tax, or we say in current tax. Okay, because we start with the EBITDA or you start with the EBIT, we don't need the change in deferred tax and current tax liabilities and assets. What you need is directly minus the income tax paid. Okay. With the EBIT, you need the D&A expense. So you need this one. You need this one. You need the provision. You need the reversal of provision. But we can suppose in the EBIT, you don't have already the impairment losses. They are in the non-current expense and income. And you have already the depletion. So we have also the depletion. Don't forget here, for the non-cash expense and revenue, what you want is to add back. If you add back, if it's because it's already included. If it's not already included, you don't need to eliminate this non-cash expense, non-cash revenue. So it depends on your starting point. Do you start from the net profit? Do you start from the profit before tax? In function of this, you eliminate some expenses, or you include directly what you pay. So here we need also the change in accrued interest payable, change in accrued interest receivable. I reduce again the size. Okay. In the other case, it's directly minus interest paid and plus interest received. Because the interest paid and interest received is not already included. So in function of the starting point, you don't do the same thing. If you start from the net profit, you need to know what is in this column. If you start from the EBITDA, you will have more of the information which is in this column, and so on. And of course, you continue to have the change in the accounts receivable, inventories, prepaid expenses, accounts payable, unearned revenue, etc. Social benefits liabilities. All this is here in the three situation. So here. Also here. In function of the starting point, you don't include the same items in the step number 1, 2, 3, 4, and the indirect methods. Okay. So in function of the first line of the statement of cash flow with indirect methods, you don't include the same items. So the potential operating cash flow here is from all the P&L. Here is from the operating activity as defined in the P&L. And here is the same with the operating activity as defined in the P&L. So we are not talking about the same potential operating cash flow after the step 1, if you start from the net profit, EBITDA and EBIT. Or it depends if you want to include also directly the interest paid, interest received, income tax paid. But it's not the same potential operating cash flow. So don't forget to look at the starting point when you compare the performance of the company. In Vietnam, you start, as we saw with Vinamilk and Vingroup, from profit before tax. In the profit before tax is like the net profit, but you don't need this one, and you put directly the income tax paid minus income tax paid. So here is if you start from the profit before tax. And here you don't have from all the P&L, excluding income tax, including the impact of the income tax. If you start from the profit before tax. Okay. So maybe I can include this one also because it's usual in Vietnam. So I will add one column, insert a column. I take the same than this one. But now we start with the profit before tax. So profit before tax. In this case, I have the impact from all the P&L excluding income tax. I don't need the deferred tax and this one. And in the last part, I need to include minus the income tax paid. So I need to use a lot all this. Okay. So of course you will have the slide after the session with all the correction. Okay, we saw. So in Vietnam, you are generally in this situation. In Europe, in US, we are generally in this situation. And sometimes you can see this one or this one. But it's less frequent because we don't have all the cash impact of the P&L after the first step. So here we can see for Samsung, we start from the net profit. We have adjustments. In these adjustments, we want to show directly after. So here we have the direct cash flow for all this. Because we want the direct cash flow and we start from the net profit, we need first to eliminate, so plus interest income. So now it's okay, I can put the interest received. No, minus, sorry, I eliminate minus. Plus interest expense. So now I can put directly the interest paid. So I can put plus interest received minus interest paid. Dividends received, it's in the financial income, interest and other financial income. So now I eliminate this one. So now I can put plus the dividends. I eliminate, so plus income tax expense. So now I can put minus income tax paid. So in order to put all this in the last step, I need first to eliminate some cash expense. So I add back, I subtract some cash expense and revenue. It's because I want the direct cash flow in the last part. So as you can see in the adjustments are here. In the adjustments, I eliminate the income tax expense. I eliminate the financial income. In the financial income, I have the interest due to the company plus the dividends due to the company. So I eliminate all this. I put minus. You can see between parentheses is minus. I want the minus here in order to replace directly by what I receive. So it's a minus here in order to do plus dividends received plus interest received. For the financial income, I eliminate the financial income plus. So here plus. So here you can see it's positive. Here is also positive. Here I have some provisions. I eliminate some provisions. I eliminate the DNA expense. Plus. The bad debt expense reversal. I eliminate what is used. Bad debt and reversal, the two. So it's plus the bad debt expense or minus the reversal. Finally, the net value is in plus. So because I have the bad debt expense here, in the second step, in the change in assets and operating liabilities, I can put the gross value for the account receivable. So because I can see the bad debt expense here, in the second step 2, here, we can say the account receivable, trade receivable, are at gross value. Okay. If I don't have the bad debt expense here, in the second step, I have in this case the net value. Okay. So here is the cash impact. Okay. Because we have the gross value. So the non-cash expense are only in this part. Here we have cash, expense, and revenue. The non-cash expense are here. I eliminate all the gain or losses. Gain on disposal, loss on disposal, loss on valuation, gain on disposal. So here I have the write down. In reality, I have the write down of inventories. So because I have the write down of inventories, I don't know why they use the vocabulary loss. Because I have the write down of inventories, in the second step, the inventories are also at gross value. So here we have the gross value for the account receivable and the gross value for the inventories. Because we have the bad debt expense and we have the write down of inventories. For the rest, the gain or loss on non-current assets, we eliminate all the gain because one part is the sale price, it's in the investing activity, and the other part is the non-cash expense, is the net book value at the moment you sell it. So the calculation of the gain or loss is equal to the sale price minus the net book value, the value visible in your balance sheet, or net carrying value. When you see the term carrying value, book value, it means it's the accounting value, it's the value in your balance sheet. When it's a gain, you eliminate, so you put minus between parentheses. When it's a loss, you eliminate, you put a plus, positive, because you do the reverse. In the P&L, the gain is plus, so now is minus. The loss is minus in the P&L, so now it's plus. And here is the same. Here is minus. So you put in minus. Here again, it's a cash cash revenue for the dividends. Dividend income is a cash revenue. We eliminate the dividend income because we replace the dividend income by the dividend received. Okay? If you want to put the dividend received, first you have to eliminate minus dividends income. Because you do minus dividend income, now you can do plus dividend received. If you don't do that, you have the change in dividends receivable. You eliminate the dividend income, you replace by the dividend received, or the other choice is directly in the second step, you want the change in dividend receivable in your asset. Because the dividends you receive maybe is different from the dividend due to the company. So you have a change in dividend receivable. So don't forget, in this part, the dividend income is not a non-cash expense or revenue. So here, discount. Here I have non-cash expenses and revenue, expense and revenue. Okay, but excluding, we can take this. We'll exclude the dividend income. So here, here, and in the second part here. Yeah. Okay. And here the dividend income and the share of profit. Share of profit, it means in your P&L, this is included in your P&L. But what you want in terms of cash is not the share of profit of associates. So associate joint venture, associate means you own between 20% and 50% of the company. In this case, if you own between 20 and 50%, what you put in your P&L is not the dividends income. The dividend income in your P&L is because you own less than 20%. So when you own less than 20% of the company, you put the dividends in your P&L. If you own between 20 and 50%, it's not the dividends in your P&L, it's the share of profit of associates. But what you want is not the share of profit, so you want to eliminate this one and to replace by the dividends received. So you need to eliminate the dividend income and the share of profit. You replace all this by the dividends received in terms of cash. So this is the cash impact. And what you have here is what is in your P&L. Okay. So here we can say all this in the step number one. So in the step one, all this is included in the P&L. And you want to replace the cash expense and revenue, all this and all this. Here we have cash expense and cash revenue. Why you eliminate some cash expense, cash revenue is because you want to replace all this directly by what you pay. Income tax paid, dividends received. So dividends received is more in this part. You replace by dividends received, interest received, interest paid. So all the cash expense and revenue is replaced by this one. So it's what you have in the last part. Okay, directly the cash effect. In the step 2, we have the change in current operating assets and current operating liabilities. So if we add all this, we have the change in operating working capital or working capital requirement. So when it's in the assets, current operating assets, current operating assets, current operating assets, and it's a decrease is plus, decrease in current operating assets is plus. It's a kind of cash inflow, minus it's a kind of cash outflow, increase cash outflow, so minus inventories, current operating assets. Here is negative, it means it's an increase in inventories. Trade payables, other payables, current operating liabilities. Advance received, current operating liabilities. The customer paid in advance, something is due to the customers. Increase in and the rest accrued expenses, current operating liabilities, current operating liabilities. So normally the operating working capital or working capital requirement is equal to the current operating assets minus current operating liabilities. Here what we want is a change. Change in operating working capital or working capital requirement is equal to the change in current operating assets minus the change in current operating liabilities. Here, we want the reverse. We want, when we increase the operating working capital, it's a cash outflow. So when we have an increase, we want a negative amount, something negative. When we decrease the operating working capital, it's a cash inflow. If you don't invest in your operating working capital, it means you have the cash. So here is positive. So the change we can replace. So I erase all this. So what we can say at the end, if we have a decrease is positive, it's a cash inflow. If we have an increase, it's a cash outflow in operating working capital. So it's positive at the end of 2020. So it's a decrease. It was negative in 2019, so it was an increase. So in 1 year, we decided to decrease, but very slightly, the operating working capital. In 2019, the situation was totally different. Because of the increase in sales revenue, we can suppose we have an increase in sales revenue, we increase the operating working capital. But because we increase the operating working capital, we are decreasing the cash. So it's a cash outflow. We can explain this with the balance sheet. So we will put the two sides of the balance sheet. Assets equal liabilities plus equity. We have the current assets. We have the non-current assets. we have the current liabilities. We have the non-current liabilities. And we have the equity. If we do current assets, 1, 2, 3, 4, 5. If we do current assets minus current liabilities, is what we name the working capital. So here, current assets minus current liabilities. But in your current assets, you have operating assets, what is needed by operating activities. And you have financial assets. So interest and dividend bearing assets. So we can own some dividends or interest because of the financial assets. So we can suppose cash included. In the current liabilities, we have the same. We have operating liabilities. So created by operating activity. So you try to pay later some expenses. So you try to increase your operating liabilities in order to save the cash. And you have some financial liabilities. So here, interest bearing liabilities. So because of the financial assets, you have some financial income. Because of the financial liabilities, you have some financial expense or interest expense. Thanks to the operating assets and the operating liabilities, you are creating some operating profit or EBIT. So excluding the financial profit. So what we want in the step number 2 in the indirect methods is only this part, this one and this one in the change in working capital. We don't want all the change in working capital because the cash, for instance, is the bottom line of the statement of cash flow. The other financial assets are included in the investing activity. The financial liabilities are included in the financial activity. We are only in the operating cash flow, so we don't want the investing activity and the financing activity, so not financial, but financing, sorry, financial activity. Financing activity. Okay. So we don't want the financing cash flow from financing activity. We don't want the cash flow from investing activity, cash flow from investing activity. What we want for the moment is only the cash flow from operating activity. So for the cash flow from operating activity, we take this one and this one. This one and this one has an influence on the cash flow from operating activity. So inside the current assets, we can separate the current operating assets from the current operating liabilities. In the current liabilities, we can separate the current operating liabilities from the current, sorry, hold on, I did a mistake here. Here I want to say current financial assets and financial assets. And here current financial liabilities. So now I have the cell number 6, 7, 8, and 9. So the working capital we said is 1 minus 2. Working capital minus current assets minus current liabilities. So it's equal to 6 plus 7 minus 8 plus 9. Okay. So when we have the change in working capital, we have the change in current operating assets, the change in current financial assets, the change in current operating liabilities, and the change in current financial liabilities. In reality, what we want is to take only what is related to the cash flow from operating activity. So here we want only what is related to the cash flow from operating activities. So we want the 6 minus 8. So here is what we name the operating working capital or working capital requirement. And we separate from the financial assets and financial liabilities. So here financial assets and financial liabilities. So here is the rest of the equation is the 7 minus 9. And this one, we can name it net cash. It is net cash. We have the cash and cash equivalents plus the short-term marketable securities. So this is the financial assets minus the bank overdraft minus the current portion of long-term debt and minus other short-term financial liabilities. Okay. So in the working capital, you have two parts. So when we say high working capital is higher than 0, is not sure you don't have liquidity problem. We generally use the working capital higher than 0 in order to estimate, to assess if we have some liquidity problem. Because of the past transaction, do we have more current assets than current liabilities? Do we have more assets we can transform into cash or it's already cash than liabilities we have to pay during the next year? So generally, we consider the working capital as a liquidity indicator. The problem with the working capital, it's You don't care if you have a huge operating working capital or a huge net cash. So in the working capital, we have the working capital requirement or operating working capital plus the net cash. But the situation is totally different if you have 100 here because you have 95 here and 5 here, or if you have 100 here because you have 60 here and 40 here. In terms of liquidity, of course, it's better to have already the cash than to have the working capital requirement at net value. So you have in the situation number one, we have a huge working capital requirement. It's not already cash. So if your customers have some problem to pay what is due, and you underestimate what you will receive in your allowance for the full accounts, because it's already at net value, you can have a bad surprise in the future. In your future, you can reduce the working capital because one part of the working capital requirement will be not paid. So you reduce the value of the account receivable at net value, you reduce the working capital, and you don't have the cash effect. So in the situation number one, you can have huge problem of liquidity in the future because your working capital requirement represents a huge portion of the working capital. And if it's not paid what is included in the working capital requirement, you will not see the cash in your net cash. So here we can have some, in the situation number one, we can have some potential problems. It's not the same situation in the situation number two, because we have already a huge part of the working capital is because of the net cash. So if we reduce the working capital requirements in the future, the impact is less in your working capital, is less a problem in terms of liquidity, because you have already a huge part of the working capital, which is already cash. So is why the working capital is not a very good indicator for future liquidity problem, because we don't separate what is already in the cash and what is for the moment in the account receivable, what is for the moment in the inventories. And maybe you will have problem to sell your inventories. Maybe you will have problem in the future to collect what is due by the customers. So it's why it's interesting to separate the two parts. And what we want in the step 2 of the indirect methods for the calculation of the cash flow from operating activity is only this part of the working capital. So sometimes I name it change in working capital from operations or excluding financial assets, because we don't want this part in the calculation of the cash flow from operating activities. So sometimes we see we have the change in working capital, but in reality, we exclude all the financial assets and the financial liabilities, because the financial assets are included in the investing cash flows and the financial liabilities are included in the financial financing cash flows. We'll come on these notions later, okay? During the session 3, we come back on the distinction working capital requirement, and the net cash. So here, in reality, we have current operating assets minus current operating liabilities. We're interested by the working capital requirement or operating working capital. So here we don't see the cash, we don't see the financial assets, we don't see the financial liabilities. So no financial assets here, no financial liabilities in this part. Sometimes the trade receivable under IFRS, they say it's a financial asset. So here we suppose it's an operating asset. So it's different from what we can see in the IFRS. So what we consider here as operating is related to the operating activity, and you don't collect interest or dividends from this. But under IFRS, accounts receivable, accounts payable are considered as financial assets, financial liabilities. So what we name financial assets here or interest bearing assets, and here interest bearing liabilities. So it's different from liabilities. You have a question? I can see. No question. It's okay. I continue. So we come back to Kahoot and we do the rest of the MCQ. Did you try to do the MCQ at home before the session? So did you try to do the MCQ from 5 to 9, or you didn't have the time to do it? Please tell me. Yes, you did it? Okay, so we can go very quickly on it. For the rest of the participants, can you say if you did it, yes or no? Yes, it's done. Okay, so we can go quickly. Please answer. Yes. Yes. Okay. So I go to Kahoot and we do and we see your answers. So I start the same Kahoot, but we did already the question 1 to 4. So you don't have to answer to the question 1 to 4. We go directly to the question number 5, and we do the correction of the question 5, 6, 7, 8, and 9. So please put the PIN code on your smartphone, 694 50 51. So 694 50 51. So I go directly to the question number 5. So don't do the question 1, 2, 3, and 4. We did it yesterday. No. So we go to the question number 5. Okay, question number 5. Now you have to answer. Why I have only 7 answers? You are supposed to participate. So the answer is the highest amount, 5.2 million. So here we add everything. We say when we decrease the operating assets, it's a kind of cash inflow. You have some revenue minus expenses. And for instance, here you have the inventories and you reduce the inventories. When you reduce inventories because you use it, is included in the expenses. But when you reduce inventories, you don't pay for that. It's already paid in the previous period. So you save the cash. You have also in the operating assets the accounts receivable.
Excuse me, sir.
Yes.
Actually, we don't see your Tahoe screen. We did not see the question, sir. And people try to communicate with you on the chat. So can you try to read sometime from the chat
Okay.
so you can understand our situation here? Sorry. Thanks.
Okay. So I come back in the session. You don't see the slide. No, nothing. Okay, come back in the session.
You are currently the only person in this conference.
So I will show you the slide and you tell me if it's visible for you. Later. Yes, here. Can you see the slide? So tell me if you can see the slide. Do you see it? Yes, no? Yes, okay. I see the slide. So, sorry for the question on Kahoot. If it was not possible to answer. Or I did again. So, yes, I come back. I stop Kahoot and we do it again. So, we start again Kahoot, okay? So, we don't care about this. And we do Kahoot again. So, please put the new PIN code. And we do again the question number 5. So I put a new PIN code and we do again the question number 5. So I go to the question number 5 directly. Don't do the question 1, 2, 3, and 4. So question 5. So in red, 3.4 million. In blue, 3.6 million. In yellow, 4.4 million. In green, 5.2 million. So the good answer is 5.2 million. We add everything. So here we have plus the D&A expense of the period. So we eliminate this one from the net profit, plus the decrease in operating assets, plus the increase in operating liabilities. Everything is in plus. Why? Operating assets, so for instance, you have inventories, you have accounts receivable. You decrease inventories, you decrease the accounts receivable. If you decrease inventories, it's outflow. It's because you are using the inventories. In your net profit, you have the revenues minus expenses. If you are using the inventories, is included in your expenses. So you start with expenses, but you are using the inventories in order to sell something. So the expenses in your P&L is not paid during the period because you are using your opening inventory. You are decreasing your inventory. So you eliminate some expenses. So for instance, in your expenses, you have 100 because of the inventories, of what you use from the inventories. So in your equation, you have minus 100 in your calculation of the net profit. So now what you do is plus 100 because you eliminate this part of the expenses. We have cash expenses. We don't pay during the period because it's already paid during the previous period when we created the inventories. So when you decrease inventories, you save the cash because you use what is already purchased during a previous period. When you decrease your accounts receivable, it means you collect the cash from the customers. So you have the collection from customers. So it's also plus. You have the revenue, the sales revenue is already here, but at the same time, we reduce what is due by the customers. So we add this cash to the potential cash in the revenue. So the revenue, for instance, is 1,000. We reduce the account receivable by 100. So now the collection from customers is the 1,000 plus the 100. 1,100. So the collection from customers, or cash inflows from the sale of goods and services, is equal to the sales revenue plus decrease minus increase in accounts receivable plus increase minus decrease in unearned or deferred revenue. Deferred or unearned revenue, it's in your liabilities. It means it's paid in advance by the customers. You sell some subscription, annual subscription to a newspaper to customers. They pay in advance the subscription. You have the cash in your assets. You have the liability, the operating liability, what is due to the customers. So in this situation, you have the cash in advance. So because it's in the liabilities, we do the reverse from the account receivable, which are in the assets. So account receivable in the operating assets, unearned or deferred revenue in the operating liabilities. For the operating liabilities, it's the reverse of the operating assets. So here is decrease is why we have the plus. Here is increase is why we have the plus. If you increase what is due, it means you don't pay now, you pay later. So we have revenue minus expenses in the net profit. But here we have accrued expenses. It means it's already expenses, but not already paid. So in June, you will pay later. So for the moment, you save the cash, not already paid. Okay. So if you increase the accounts payable, the accrued expenses, the tax liabilities, the social benefits liabilities, and so on, it means it's already expenses, it's already in your net profit, but it's not already paid. So we don't have the impact in terms of cash. This is not a normal situation. Normally, you should have the same direction for the operating assets and operating liabilities. So here is not normal. Maybe we have a problem. Maybe we need a huge operating cash flow in order to repay the debt. So maybe we try to maximize the operating cash flow because it's compulsory to repay a debt of 5 million, for instance. So we try to increase at the maximum the operating cash flow in order to be able to repay the debt. But in this situation, we can have problems. Maybe it's a situation with an increase in sales revenue. So we are selling more than in the past, but we decrease the operating assets. So we are decreasing the inventories. If we decrease too much inventories, we can have problems in the future if we continue to increase the sales revenue. If you don't have any more some inventories, how do you sell the goods the customers want? So in a situation with an increase of the sales revenue, normally you increase your operating assets, you increase your operating liabilities. In a situation with a decrease in sales revenue, normally you decrease your operating assets, you decrease your operating liabilities. In all the cases, the direction of the two should be the same. So it's not normal to have a different situation for the operating assets, operating liabilities. So I go on the whiteboard. So generally, we are interested by the operating working capital or working capital in percentage of the sales revenue here. So if this one is positive and you are an increase in sales revenue should increase your current operating assets and you should have an increase in current operating liabilities because the ratio is positive. If your ratio is negative, it's the reverse. An increase in sales revenue should decrease your current operating assets and current operating liabilities. So at the end, we have a decrease in operating working capital. In the previous situation, it was an increase in operating working capital. So here it is the situation of Amazon, as we saw yesterday. They have a negative operating working capital. The ratio is negative. So when they increase the sales revenue, they decrease the operating working capital. They have a source of financing because the suppliers finance the inventories. So when we increase the activity, we pay later what is due to the suppliers. We increase the accounts payable more than we increase inventories. So we have a source of financing. We increase more the liabilities than the assets. Next question. Do you see Kahoot? It's okay? Do you see Kahoot now? The sound is not stable. Are you mute? No. Can you hear me? Yes, you see Kahoot and you can hear me? Yes. Yes, you can hear me. Okay. So now question number 6. For the question number 6, if you go in the module, you have the Excel file. So if it's not already done, please download the Excel file. In the session number 1, you download the Excel file. And you can do the exercise in the Excel file. Okay? So you have the Excel file here. And what you have to calculate is the operating disbursement. Okay, operating disbursement. So the cash outflow from all this information, in your opinion, what is the cash outflow because of the operating activity? Okay, operating disbursement. So I show you the question and you have 4 minutes to do the calculation. Question number 6. You use the Excel file and you have 4 minutes for the calculation. So in red, you have 1,033,000, in blue, 1,067,000, in yellow, 1,073,000, in green, 1,093,000. So the good answer is 1,073,000. And we do the correction, and we have the break after the correction. So I save the Excel file with the correction. With answers. So again, we can apply the 2 steps in the calculation. So step 1, we add back non-cash expense. Okay. So maybe I need the same size, 14. Okay. So we start from the operating expense. We add back the non-cash expense. And in the step number 2, we have the change in current operating assets and current operating liabilities related to operating expense. Here we want the cash outflow. Okay. Here is the step 2. Format. Okay. So first we need the operating expense. The operating expense we have by function and by nature. Under Vietnamese GAAP, in your P&L, you have to put operating expenses by function. Under IFRS or US GAAP, you can put by nature or by function in the P&L. So here we have operating expense by function with the cost of sales. Okay, the cost of sales is equal to cost of sales is equal to the cost of goods manufactured sold, cost of goods sold. Okay. So here is what you produce and you sell. So here is for the manufacturing company. We can say cost of goods sold just. So here is for the manufacturing company. Manufacturing company. Plus the cost of merchandise sold. It means you don't transform the product. You are a merchandise company. You purchase something and you sell it without transformation. Plus direct cost of services rendered. So here you are a service company. So when we talk about the cost of sales, we can have 3 parts. The cost of the products you transform and you sell. The cost of the products you don't transform, what we name merchandise. And the cost of the services, the direct cost of the services rendered. So here is for the situation, for instance, the cost of sales is the situation of Vietnam Airlines. In Vietnam Airlines, you have the cost of sales is because of the direct cost of services rendered. Okay. Mainly in this one. You have a small part in the cost of merchandise sold, but not a lot. Because of the food and the drink in the during the flight. So you have here mainly and a small part in this one. And nothing here because it's not a manufacturing company. So here is operating expense by function. SG&A expense, it means SG&A expense means selling, general and administrative expense. So in this one, you have the commercial or selling expense. So all the stores are here. expenses because of the stores. You have the administrative expense. So all the expense because of the headquarters. And you have the research and development cost expense. So all the costs because of the laboratories. So when we say we have operating expenses by function, we have 4 functions. One is about the production, cost of goods sold. One is about the commercial expense. One is about the administrative expense. And the last one is because of the research and development expense. So we have the 4 functions. So if we have the cost of sales plus the SG&A expense, you are sure you have the total operating expense. What we name total operating expense, it's what we use for the calculation of the EBIT. Sales revenue minus total operating expense is equal to the operating profit or EBIT. Okay. In the US, sometimes the SG&A expense, we name it operating expense. So they separate the SG&A with a different name from the cost of sales. We have this situation, for instance, for the merchandise company. In the merchandise company, they say for the SG&A expense is operating expense. So SG&A expense is also operating expense by function. Employee cost, it's operating expense by nature. Components used for production, operating expense by nature. D&A expense, operating expense by nature. The total operating expense, you can calculate the total operating expense in 2 ways. Total operating expense with operating expense by nature or by function. So you have the choice between the two. At the end, we have the same total operating expense. Here we are sure we have all the total operating expense because we have 4 functions in the company. So if we add the cost of sales and the SG&A expense, we are sure we have the total operating expense. So 700,000 plus 1.2 million. If you add the operating expense by nature, you have less. So some operating expense are missing in the operating expense by nature. So if we want by nature, we need the 600,000 other operating expense. So here we should have other operating expense. Insert. Okay. So here we can say we have other operating expense by nature. So the difference is equal to the sum of this one and this one minus what we have already here. So here, missing operating expense by nature in the wording. Okay. No, it's not this one. Okay. So we let like that. Okay. Oof. So the operating expense is 1.9 million, but inside the 1.9 million, we don't pay the D&A expense. So we don't pay this one. So we need to eliminate this one. So minus this one. What we pay is the rest. So the potential operating cash outflow is the rest. 1.9 minus 0.4. So this is what we should pay, 1.5 million. The question is, do we pay this amount? So we have information about operating assets. So operating assets is here. And suppose it's current operating assets. Prepaid expenses, current operating assets. And that's enough. So we can have a gain for this one, a gain for this one, okay? So opening and ending. And the rest is current operating liabilities. Current operating liabilities and current operating liabilities, opening and ending, okay? So in the change in current operating assets, we have the change we have the change in finished goods inventory, and we have the change in accounts payable, receivable, sorry. In the change in current operating liabilities, we have the change. No, it's not account receivable, sorry, it's in prepaid expenses. And here in accounts payable, and the change in accrued expenses. And here in prepaid expenses. Okay. So for the change in current operating assets, when we have an increase is negative, so minus the increase or plus the decrease. When we have operating liabilities, it's the reverse here. We are talking about expenses. So we do the reverse. We increase the cash outflow, we decrease the cash outflow. Here is the reverse. If we don't pay, we decrease the cash outflow. If we pay, we increase the cash outflow. So because here we are talking about the cash outflow only, okay? So now what I need to do is plus increase, so I need ending minus opening. So for the finished good inventory, I use ending minus opening. So ending minus opening. So because I increase the finished good inventory, I will have to pay the increase. So here we have an increase. For the prepaid expenses, I do ending minus opening. Prepaid expenses, ending is here, opening is here. So again, I have an increase, so I pay for the increase. So I pay in advance, for instance, some insurance. I don't use the insurance for the moment. I pay in advance, I will use the insurance later. So it's a prepaid expenses in your assets. Now, in the accounts payable, it's the reverse. When I increase the liabilities, it means I don't pay. I will pay later. So what I do, it's opening minus ending. For the accounts payable, I need opening minus ending. Opening minus ending. So it's a minus, so it means I have an increase. So here it's a minus increase. Minus increase. It's the same for the accrued expenses. It's liabilities, so opening minus ending. So accrued expenses, opening minus ending. It's positive, so it's a decrease. So here, decrease. Okay. Now I have the operating disbursements. The operating disbursements is the sum of everything. So I put some potential operating cash flow. So I have already the sum after the step one. So I take the rest. So it's 1,730,000. The operating disbursement. It's okay with the calculation? Do you have questions? So I put the answers, the Excel file on Canvas now. If you have questions, tell me. In the other case, we do the break. It's okay with the correction? I put the correction on Canvas. We take 10 minutes and we continue after the break. Okay. See you in 10 minutes. I put the correction now. I stop the recording and we continue the session. During the break, I try to put what I did in the whiteboard on the slide. So I created this slide. I hope you can see it later. You can increase the size and to see the information. I put on the whiteboard. So I put on one slide in order to keep this information. But in the slide of the session 3 and 4, we'll come back on the working capital requirement, and the net cash. And I made a mistake, is 1 minus 3. Current assets minus current liabilities, not 1 minus 2. So in this way, you have the slide with the chart diagram. So now we go to the MCQ. It was the MCQ number 5. Number 6 is done. So now we will do the MCQ number 7. So we continue with Scout. So I go to the question number 7. You have 4 minutes to calculate the net profit. Okay. So here we reverse the process. You already have the net cash flow from operating activities, and you want to come back to the net profit. So 4 minutes for the calculation of the net profit. So the good answer is 1.68 million. So I go to the PowerPoint, I take the wording, and we go to the whiteboard. Okay. So we can create a kind of table. So I separate 4 columns. 1, 2, 3, and 4. So the question is it included in cash flow from operating activity? It's a cash flow. Is it included in the P&L? And the answer is yes or no. Yes or no. So what we want is what is included in the P&L. If it's included in the CFO, in the operating cash flow, and not included in the P&L, we need to eliminate. So if the answer is yes and here no, we have to add back. If the answer is no for the cash flow and yes for the P&L, we have to include. Okay. If the answer is no for the two, we don't care. If the answer is yes for the two, it's already included. Okay. So the D&A expense is not a cash, so not included in the operating cash flow. Okay. So it's not in the operating cash flow, but is included in your P&L. So we need to include this new expense. It's expense, so we put minus. So minus the D&A expense. Not already included in the operating cash flow, not already included in the 2 million, but we have to include in the net profit. So, and it's expense, so minus. Increase in inventory, already included in the calculation of the operating cash flow, but we don't care about this one in the P&L, because what we want in the P&L is what we sell. Increase in inventory, it's a cash outflow, and we need to eliminate this one for the calculation of the profit. So we do the reverse, it's minus in the cash, we want to eliminate, because it's not included in the P&L, so it's plus. Plus increase in inventories. Decrease in unearned or deferred revenue is not included in the operating cash flow because it's already paid during the previous period. If you decrease the unearned revenue, it means the customer is using one service already paid during the previous period. So it's no more a cash flow during the period, but it's a revenue during the period. Sorry, it's not included. So here is no, not included in the operating cash flow, but it's included in your P&L. It's a revenue, so it's plus in your P&L. So you increase the revenue because of the services used by the customers. Increase in prepaid expenses. It means you pay from some services you will use later. So yes, is included in the operating cash flow, but no, is not already included in the P&L. So we need to exclude this one. And this one, it's a cash outflow. You pay for the insurance, for instance. So you eliminate the decrease in cash outflow. So it's the reverse. It was minus, so now it's plus. With the sell price and the net book value, you have the calculation of the gain or loss on disposal of property, plant and equipment, and intangible assets. We don't know if we are talking about intangible assets or property, plant, equipment. Here, the calculation, it's 130,000 the sale price minus 170 the net book value. So we finish with minus 40,000 in dollars. So it's a loss. So the sale price and the net book value are not already included. The sale price is in the investing cash flows, so it's not included in the operating cash flow, and is included in the P&L. The net book value, it's a non-cash expense. So here is investing activity. Non-cash expense, it means not included in the operating cash flow, but it's included in the P&L. So now we need to put the sale price is plus minus the net book value. We want the calculation of the gain or the loss. So finally, the calculation is 2 million minus 0.8 million because of the D&A, plus 0.2 because we add back the increase in inventories, plus 0.22 because we increase the revenue thanks to the decrease in unearned revenue, minus plus 0.1 because we eliminate the prepaid expense. It's a cash outflow, but it's not already expense, plus the 0.13 for the sale price, minus 0.17 for the net book value. And now we have the calculation of the net profit. So the net profit is equal to 1.668 million. So if we come back to the whiteboard, it's 1.68 million. So minus the D&A expense, plus the increase in inventory, plus the decrease in unearned or deferred revenue, plus increase in prepaid expenses, plus the sale price, minus the net book value. So we can use the normal calculation with the indirect methods from net profit to operating cash flow. And now we do the reverse. So on the right side of the equation, we have the operating cash flow. On the left side, we have the net profit and the step 1 and the step 2. And now we reverse and we keep on one side the net profit and all the rest on the other side of the equation. Next question, question number 8. So from all this data, in your opinion, what could be the payment to suppliers of components? The most likely payment to suppliers of components. So question number 8 in Kahoot. You have 4 minutes to calculate the payment to suppliers of components. The good answer, 705,000. So we will see the correction. So in your P&L, you have the calculation of the operating profit. Operating profit, or EBIT, is equal to the operating revenue, mainly sales revenue, minus operating expense. The operating expense are in function of the sales revenue. In function of. So it means for the components, what is here when we have components expense is for the finished goods sold. So it's in function of the sales volume. So here, it's in function of the sales volume. Okay. What you need is not in function of the sales volume. What you want, it's in function of the production. So you want the components used for production. But you have one information. We know that the change in finished good inventory is equal to 0. So it means production volume equal sales volume. So we produce what we sell. So the components used for production is equal to the component expense. From the components used for production, we want to know the components purchased. The inflow in components inventory. Here, the components used for production is the outflow from components inventory. So in the between, what we have is the change in components inventory. If we increase the components inventory, it's because we purchase more than we use. If we decrease the components inventory, it's because we purchase less than what we use. And what we use is because of the production. And from the components purchase, what we want to know, it's what we pay. So it's the payment to suppliers of components. So we need to have all this process. If we start from the P&L, we have something in function of the sales volume, but what we want is in function of the production volume. So here, it's in function of the production volume. After, what we want is something in function of the purchase volume. And at the end, what we want is a cash outflow. So we want some operating disbursement. So this is all the process. Okay. So later I will put in one slide this diagram. Okay. So I keep this one, and later I will put in the slide. So if we go to the correction, so we have the component expense. How we can find the component expense is by difference. So the total operating expense is here. And here we have operating expense excluding components expense. So by difference, we have the rest. So in order to find 1,770,000, we need the component expense. So by difference, 1.77 million minus 0.12 minus 0.8 minus 0.16 minus 0.09, we have the components expense. So the component expense, it's 0.6 million. So 0.6 million. 2.6 million is the component expense in function of the sales volume. But the change in finished good inventory is 0. So it means the component expense, so thanks to this one, we can say components expense in the P&L is equal to the components used for production. Components used for production. So here we have the same value. Okay. And now we want the components purchase. The components purchase is the inflow. Here we have the outflow from components inventory. Now we want the inflow. So the inflow is equal to the outflow plus ending inventory. So now we have all the available inventory. Ending inventory is about the components inventory minus opening inventory. So it's plus the increase or minus the decrease. Okay. So here for the components inventory, we start with 90 and we finish with 265. So we increase inventory by 175,000. Increase. So if we increase inventory, we add this amount to the outflow. The outflow is 600,000. I add the 175. So now I have 775,000. So this is the components purchase during the period. And now the last one, the payment to suppliers of components. For the payment to suppliers of components, what is the difference with the previous value? The difference between the components purchase and the payment is because of the change in accounts payable for the suppliers of components. Okay. So if we don't pay all we purchase during the period, it's because we increase the accounts payable. If we pay more than what we purchase during the period, it's because we decrease the accounts payable. We start with 120,000. We finish with 190,000. So we increase by 70,000. So it means we pay 70,000 less than what we purchase. The only way to increase your liabilities is because your expenses are higher than what you pay. So here, we purchase more than what we pay. It's not exactly expenses, here is purchases. So here, we have minus the increase in accounts payable. Two ways, if you purchase for 775, one way is to pay later, you increase your liabilities, or the other way is to pay. So the cash outflow plus the increase in liabilities is equal to the purchases. So finally, the payment to suppliers of components, it's 705,000. Answer number 3. It's okay with all the process from the P&L to the cash outflow? It's okay with the process? So I will take the diagram from the whiteboard and later I will put on the PowerPoint, okay? Do you have questions about the calculation? So don't forget, in your P&L, you have expenses in function of what you sell. But if you want the payment to the suppliers, you have to come back to expenses in function of what you sell, to the expenses in function of what you produce. After, you need the purchases, and after, you need the payment. It's okay? I suppose. So we continue with Scout. Next question. Question number 9. Question number 8. Question number 9. Question number 9, you have the Excel file. So please download the Excel file. From all this information, you have to find the operating disbursements. So we purchase the bikes and we produce e-bikes. So the e-bikes is the finished good, what we produce. What we produce is the finished good, okay? So what we sell. And we purchase the bikes in order to produce the e-bikes. So from all this information about the activity, you have to find the operating disbursement. So if we go to the module session 1, we have the MCQ number 9. You can download the Excel file and we do the calculation. So the Excel file is here. So from the Excel file, you have 4 minutes to calculate the operating disbursement. So it's about the cash outflow, okay? So I put in count. Next question, last question, question number 9. So the good answer is 816,000. Maybe it was too fast to calculate in 4 minutes. So I will present different ways to calculate the operating disbursement. So I will save the Excel file with answers. So MCQ number 9 is answers. Okay. So if you want to calculate very quickly the amount, you can use the direct methods. Direct methods. In the direct methods, you want the payment to suppliers of bikes. After the bikes, you have the components. So payment to suppliers of components. You have the employee cost paid. You want the utilities cost paid. You don't pay the DNA expense, non-cash expense. You want the advertising expense paid. And that's it, okay? So maybe I put some information about the prepaid expense. No, we don't know what is related to. So we suppose here prepaid expenses, we can add some information. We have no difference. It's not a difference in the calculation. It's just to give some meaning and to link to some accounts. So we'll suppose assumption prepaid expenses are related to advertising expense. Okay. So it's just to put directly with the advertising. In the other case, you have to put a line for the prepaid expense. Now, the direct method here, we have the total operating disbursement. Okay. So the payment to suppliers of bikes. So we have the purchase. The question is what is paid. So for the accounts payable, we have no information also for the accounts payable. So we suppose the accounts payable are related to suppliers of bikes. Okay, we put in this one. So here, for the payment to suppliers of bikes, we have what we purchase, the 200,000, and we want what we pay from that. So if we don't pay, it's because we increase the accounts payable. So minus the increase in accounts payable. So minus between parentheses, ending minus opening, accounts payable. So ending minus opening. So if I increase the accounts payable, here I increase by 9,000, is because I don't pay a portion of what I purchase. So what I pay is the rest. So here minus the increase in accounts payable. So what I pay is 191,000. Okay. Payment to suppliers of components. So I suppose is all cash paid. Okay. So here, components purchase is cash paid. So I put directly the value. 120,000. employee cost paid, I suppose all is cash paid. I have no information about social benefits liabilities, so I put directly. So normally for this one is equal to the employee cost minus the increase or plus decrease in social benefits liabilities for the payment of suppliers to components, normally the purchase of components minus the increase plus the decrease in accounts payable related to suppliers of components. The bike is the same, but here now it's suppliers of bikes. Bikes and purchase of bikes. All the time, what they purchase here minus the increase in accounts payable related to suppliers of bikes or suppliers of components. So the utility pays, I suppose, is cash paid. So I take directly this one because I have no information about this. But normally I could have accounts payable related to suppliers of utilities. So here, purchase of utilities minus the increase or plus decrease in accounts payable related to suppliers of utilities. Okay. Advertising expense paid, I take the 45 and I say the prepaid expenses are related to advertising. So it means prepaid expenses I pay in advance. If I increase the prepaid expense, it's more cash outflow. If I decrease the prepaid expense, it means it's already paid during the previous period, and now I'm using this service, so now it's expense in the P&L. So what I need is plus the increase. So advertising expense plus increase. So plus ending minus opening. And now I have all the expenses, operating expenses paid. So I have all the operating disbursements. 118,000. So this is the direct methods. If I want to use the indirect methods, I need to calculate first the operating expense. So now I want to use the indirect methods. So I start from the P&L for the operating expense. And from the operating expense, I will have the step 1. Add back cash expense. And the step 2, change in current operating assets and current operating liabilities related to operating expense. Okay, and I finish with the operating disbursement. So for the calculation of the operating expense, so operating expense, I need the bikes used for production. I need the components used for production. I need the employee cost. I need the utilities cost. What else? I need the advertising expense. But don't forget, I have bikes used for production, components for production. My problem is I have too much expenses if I produce more than I sell. So I need the increase plus increase or minus decrease in finished goods inventories. So thanks to this one, now it's in function of the sales volume. Don't forget, here is in function of the production volume. Bags used for production, components used for production, is the outflow from the bags inventory. Outflow from bags inventory. This one is the outflow from components inventory. But the outflow is in function of the production. In reality, what I want is in function of what I sell. So I will represent the process. I have the components inventory. Components inventory. I have what I purchase, the components purchase. I have the opening inventory. I have the ending inventory. And I have the outflow, the components used for production. I have the same thing for the bags inventory. I have the bags purchase. I have the opening inventory. I have the ending inventory. And I have the bags used for production. Now I have the e-bags inventory. What I produce. So here I have the cost of goods manufactured because of the components used for production, because of the bags used for production, because of other manufacturing costs. Direct labor cost, DNA expense, and so on. So this is the inflow. I have the opening inventory. I have the ending inventory, and I have the outflow, the cost of goods sold. And the outflow will go inside the P&L. In the P&L, I have the sales revenue minus the cost of goods sold. I have the gross profit or gross margin. Minus the SG&A expense. I have the operating profit or EBIT. So the cost of goods sold is in function of the sales volume. So here is in function of the sales volume. The cost of goods manufactured is in function of the production volume. And the components purchase and the bags purchase is the purchase volume. So with the indirect methods, I need to start from the sales volume because I want to start from the P&L, and I need to come back to the purchase volume. So here, for the moment, we have expenses in function of the production volume, components used for production, bikes used for production, and other manufacturing expense. So maybe we write this one. It's components used because after I will put on the PowerPoint components used for production. Okay. So for the moment, we have the cost of goods manufactured. The cost of goods manufactured is in the bikes used for production, components used for production, some employee costs, some utility costs. With the change in finished goods inventory, now I will transform in order to have the equivalent to the cost of goods sold and the SG&A expense. So at this level here, if I include only this, if I include all this, I have the equivalent of the cost of goods manufactured plus the SG&A expense. So if I include all this, I have the cost of goods manufactured plus the SG&A. If I want the equivalent of the cost of goods sold plus SG&A expense, it means all the operating expense in function of what I sell, total operating expense. I need to include the change in finished goods inventory. Okay, because I need the cost of goods sold. So with the ending minus opening, I have the increase. So here I can say, change the color, I put this one in blue. The cost of goods sold is equal to the cost of goods manufactured. So the production cost of the period, so the production cost of what I sell, is equal to the production cost of what I manufacture during the period, minus the increase or plus the decrease in finished good inventory. So here, e-bike inventory. Okay. So it's why I use the minus increase in finished good inventory in order to transform the equivalent of the cost of goods manufactured into the cost of goods sold. And now I have the total operating expense. From the total operating expense, what I want is the operating disbursement. So I need to add back the non-cash expense and after the change in current operating assets, change in current operating liabilities. So I need to calculate the change in current operating assets. So in this one, I have the change in bags inventory. I have the change in components inventory. I have the change in prepaid expenses. And it's enough. In the change in current, I will take the previous one. In the change in current operating liabilities, I have the change in accounts payable. I have the change in I have other change in prepaid expenses. No, it's enough. I don't have accrued expenses here. Okay. So just one. So we start. So the bags used for production. Bags used for production is the outflow. So it's what I purchase plus the opening minus the ending. 165,000. Some of this. Components used for production is the outflow. So what I purchase plus the opening inventory minus the ending inventory. Employee cost, it's here. Utilities is below. And advertising, I suppose, is below also. And now the increase in finished good inventory. I know it's DNA below. So here is not the good one. I want the advertising expense. And I forgot the DNA. Sorry. Forgot the DNA. So increase in finished good inventory. So we need the ending minus the opening, ending finished good inventory minus opening. So increase by 36. So now I add all the operating expenses. 907,000. So the first line in the indirect method is 907,000. I put in 16 also. I add back the non-cash expense. So I eliminate the DNA. So you see, you have the DNA here. I put in yellow because you have the DNA here. So I eliminate this one. Okay. Now I want the change in current operating assets, change in current operating liabilities. So change in operating working capital. Okay. Related to operating expense. So in the bags, if I increase the bags inventory, it's a cash outflow. So I will put directly the cash effect. So I put opening minus ending. So here, opening minus ending. Because of the increase, it's a cash outflow. Okay. For the components inventory, I do the same. Opening minus ending. So don't forget this one and this one, I will put in blue, is already included in this one. Okay. Because here the calculation is bags purchase minus the increase or plus the decrease in bags inventory. And now I have the cash outflow. It means I have minus the increase. In bags inventory. I know it's the reverse, it's plus. I want in plus the cash outflow, sorry, plus the increase. So here I do the reverse, sorry, D4 minus D3. When I increase, I have new expenses, okay? When I increase, I have new cash outflow, sorry. So I will put in positive when it's a cash outflow, in negative when it's equivalent to a cash inflow, kind of cash inflow. In reality, the company saves the cash. they don't spend the cash because they are using the opening inventory. Here, for the components inventory, we start from 48, we finish with 32. So we take 16 from the inventory. So here we do the reverse. Okay, so kind of cash inflows, it's equal to minus, we have a minus decrease in components inventory. For the prepaid expense, the same. We will do ending minus opening. It's a cash outflow if we increase the prepaid expense. So ending minus opening. So we spend 10,000 because of the increase. So here, cash outflow, because it's an increase in prepaid expenses. For the accounts payable, if you increase, it means you save the cash. So it should be negative when you increase. So we do opening minus ending. So accounts payable, opening minus ending. So because we increase, we save the cash. So a kind of the same as the previous one, kind of cash inflow, because we have increase in accounts payable. So now I can take the sum of the two. Change in current operating assets, change in current operating liabilities. So here I do the sum of all of this. I do the sum of this one, I have only one. So here I have the total. We have the total. Here I have the total. So I put the 2, the 29, and the 9. I have already the sign if it's cash inflow or outflow. And now I add all this. Oh, and it's false. What is the problem? The accounts payable, I increase the accounts payable 28, and now I have 37. Yes, I increase. So the increase should be negative. And for the components inventory, I decrease is negative. It's okay. I increase. So I don't understand. I will check after what I miss. Accounts payable, prepaid expenses, everything. We don't care. So accounts receivable, not relevant. Here, and accounts receivable again, I should have the not relevant. Can I use all the rest? Prepaid expenses, depreciation. I'll check. But the good answer is 860. The other way to do the calculation, other possible calculation. Okay. Is to take directly only the purchase. Directly the purchase. After the components purchase, all the expenses, the cash expenses, so employee cost, utilities. We don't care about the D&A. So advertising. So here we use only cash expenses. We have the purchases. And here we put directly minus. It's because minus increase. No. No, it's okay. So after I add the increase plus increase in inventories, so I have the finished goods and components. So I put directly all the inventories because I start from the purchases. After I have the plus increase in prepaid expenses, I have to pay for that. It's not already included. So before here, I have all the operating expense, cash operating expense is here. Format. Okay. So here I have all the cash operating expense with all this. After I need the increase in prepaid expense, and I need minus the increase in accounts payable. And again, I will have the total operating disbursement. So 3 ways to calculate. You start from the P&L, but you need to eliminate many things. Or you have the direct methods. You directly take what you pay, the cash outflows. And the last version, you calculate only with the cash operating expense, so you eliminate already the D&A, and you need the rest because of the credit terms. You pay in advance, you pay later. So here it's because of the credit terms effect. Okay. So I finish the correction because it's already 11. I finish the correction and I put the correction on Canvas. And if it's possible for you to start one case study for the session 1, because I spend a lot of time in the correction, maybe for the next session, you can try to do Young Company statement of cash flows. So for tomorrow, if you can start the exercise, you can try to do the exercise, and we start directly with the correction of this one. Young Company statement of cash flows. So I take 2 minutes to present the case. So in this exercise, we suppose we have a new company. We have information about the new company. The company started the activity in February of this year. We have the commercial performance, sales revenue. We have information about investments. We have information about the debt. We started debt at the beginning of February. So we can specify debt specification is financed by debt. So we start the debt at the same moment that we have the investment. We have some information about operating expenses. We have information about the working capital requirement. So here you can use directly the data. Okay, I put here in the cell in numbers custom. I put sales revenue here. So it's not a problem. You can use directly the data. Okay, you can add the numbers. It's not a problem. For instance, if you want to add everything here, you will have the same format of the sales revenue. So from all this information about the operating activities, investing activity, and the financing activity, so here investing activity, here financing activity, you have to complete the P&L, profit before tax. You have to calculate the ending working capital at the end of the year 2021. So here is for all the year 2021. We start the activity on February 1st and to the end of the year. So it's the forecast for this year. You have to calculate the operating cash flow, the investing cash flow, and the financing cash flow. So here is for the year 2021 with the indirect methods. And after, if you have time, you try to calculate with direct methods and another indirect methods. So try to do the statement of cash flow for this new company for the year 2021. So it's a forecast. And you start with the P&L forecast. So try to do this for tomorrow, and we start with the correction of this exercise during the next session. Okay? And I put the correction, I will finish the correction just after the session, and I put the correction of the question number 9. You have also the correction on the slide. I will put the slide today with the correction, okay? The 816,000. So different ways to calculate with the direct methods or indirect methods. So next time we start the slides of the session 3 and 4, and we start directly with the correction of the Young company, the statement of cash flow for the Young company. Thank you to everybody, and see you tomorrow. I stop the recording.